of two regional banks has revealed the delayed effect of the Federal Reserve's approach to fighting inflation.
Rising interest rates was one of the biggest problems that bit them two ways.
Experts say the collapse of Silicon Valley Bank was partially triggered by rising interest rates. That's because the bank invested heavily in government bonds 2 years ago. And as the Fed raised rates at a rapid pace, bond prices fell, meaning the value of Silicon Valley's investments plummeted.
You had venture capital companies that needed their money. Because of rising interest rates, they weren't worth as much and couldn't come public. And then you had Silicon Valley that was sitting on very liquid treasuries that were worth less, significantly less, than when they first purchased them.
According to the Wall Street Journal, an accounting firm's audit gave Silicon Valley a clean bill of health just 2 weeks before the bank failed. The Federal Reserve Board is now launching a review of the bank's supervision and regulation. Regulators also took control of Signature Bank of New York over the weekend. It was one of a handful of banks that allowed customers to deposit cryptocurrency. In the wake of the bank failures, investors today will turn their attention to the government's new inflation report. It's expected to show the inflation rate dropped to 6% last month. Still high, but lower than the 6.4% rate in January. If the news is worse than expected, it could trigger the Fed to be more aggressive about raising interest rates again when it meets next week, possibly raising rates by 0.5 point. But some economists predict the Fed will think twice in the wake of these recent bank failures.
Going forward, we don't expect that type of increase for the Fed funds rate. So even though rates may drift higher, they'll be more manageable for the banks because the rate of change will be slower.
Meanwhile, the parent company of Silicon Valley Bank and two top executives are now facing a class action lawsuit. Shareholders accuse them of concealing the risk the bank was facing from those higher interest rates.